What is accounts receivable? It is the money customers owe a company for products or services they already received. The image calls this an investment because the reward, you get new customers by letting them pay later. The risk, some customers might not pay at all, bad debt. What is reconciliation? It is the process of matching two different lists to make sure they say the same thing. List A detailed every single unpaid bill from every individual customer. List B, the big total, the total amount of money owed written in the company's main record book called the general ledger. Why does it matter? If these two lists don't match, the company's financial reports are wrong. Doing this fact check ensures that the numbers the company shows to owners, banks, or the government are accurate and justified. 1. Manual errors. The oops factor. This happens when someone is typing in data and simply misses a step. For example, they might record a sale in the specific customer's folder but forget to update the main company record book. 2. Posting mistakes. The wrong label factor. This occurs when money is recorded in the wrong category. Instead of putting a bill under Customer John Doe, it gets accidentally dumped into a generic pile called trade receivables. The total money might be right, but the details are messy because you can't see who actually owes what. 3. Timing issues. The calendar factor. This is the most common cause. It happens when you compare to reports that were created at different times. Example, if you check the main record on Monday morning, but the customer list was printed on Friday afternoon, they won't match because new sales or payments likely happened over the weekend. 7 golden rules that companies use to keep their financial records clean and accurate. Think of these as safety checks for the money the company is waiting to receive. Here is the simple breakdown. 1. Zero credit balances. Generally, a customer's account shouldn't show a credit, meaning the company owes them money. If it does, you need to find out why. 2. Subledger alignment. The list of every individual customer's bill must add up perfectly to match the grand total in the main company record book, the general ledger. 3. Entry awareness. You need to know how the numbers got there. Did a computer do it automatically, or did a human type it in? Humans make more mistakes. 4. Review collections. If you receive a payment but don't know who sent it, don't just ignore it. Find out who it belongs to immediately. 5. Aging reports. Keep a list of how old each debt is. The longer someone takes to pay, the more you need to focus on collecting that money. 6. Authorization. No one should be allowed to change a customer's balance, like giving a discount or deleting a bill, without a signed permission slip or document. 7. Restrict manual entries. To prevent fraud or simple errors, only a few trusted people should be allowed to type numbers into the system by hand. Summary. These rules are all about accuracy and honesty. By following them, a business makes sure it doesn't lose money or report the wrong numbers to the bank. This final shows the reconciliation checklist, which is a to-do list that divides work between two people to ensure no mistakes are made. In accounting, we call these two people the preparer, the person who does the actual work, and the approver, the supervisor who double-checks the work. The work split. Most of the tasks involve both people checking off on them to ensure 4 eyes see every number. Entering transactions, making sure every single bill and payment is typed into the system. Comparing documents, looking at the source documents, like bank statements or invoices, and matching them to what is written in the company records. Solving old problems. If a debt is older than 90 days, 3 months, they must work together to create a plan to either collect that money or remove it. Making adjustments. If the numbers don't match, they decide if they need to create an adjusting entry, a correction, to fix the balance. Final verification. Checking one last time that the big total, GL, and the detailed list, subledger, are exactly the same. The final sign-off. Both people sign the document. This is the official proof that the company's financial records are correct. Why use two people? This checklist is a form of internal control. If only one person did the work, They might accidentally miss a mistake or, worse, try to hide missing money. Having an approver ensures that the company stays honest and the books stay clean.